Welcome to the weekly update, where I'll go over the action in the market for the week of June 10th through the 14th, and then we'll see how things look for the week of June 17th through the 21st. The market is supposed to be closed on Wednesday in observance of Juneteenth, so we're going to kind of have a day off right in the middle of the week in this upcoming week. We are looking positive on the daily charts, but there's some real vulnerabilities right now. If you want to really look at those more in depth, please watch the daily videos that I post. This has been building up for over a week now, where we're seeing higher highs with the S&P, but we're not seeing a lot of strength with the whole market. And at some point, something's going to have to give here. But for right now, we are looking positive. Some of those negative divergences I will show you because we're seeing them also on the weekly charts. But for the most part, we're looking pretty positive. The S&P did set an all-time high this past week. We had the NASDAQ and NASDAQ 100 setting all-time highs, especially in Friday's session. So things are looking pretty positive, but as always, there are some warning signs that we need to pay attention to. Before I start, please know that I do post videos every day. Now, they're locked down now. If you want to have access to those right after they're recorded and made available, you'll need to join the program that I have, and it's free for the month of June. I'll talk about that here just in a moment. But the daily videos are the real foundation of my analysis. The weekly videos that I do, I consider them to be more supplemental. We get a big picture. For some of you, that's as far as you want to take things. That's fine. If you want to get more in depth with what's going on in the market, the daily videos are really the thing to view. I do have a PDF that's available in the description below this video and every video that I post, both on YouTube and on Rumble. There are pivot points that are posted on the YouTube community tab. I update those every day. Those are really helpful as support and resistance areas. I do have a private Facebook group. It's not really active, not an awful lot of members. You're welcome to join. If you don't want to become a member, but you still want to have some back and forth with me, this is a private group and we can still carry on conversations. Pretty much the only thing I'm posting right now are the videos as they're being made available. I just post a link to those videos. And I'm really careful about YouTube and Rumble comments. The YouTube comments have been pretty good lately. Every once in a while, I get one of those, hey, if you contact Sally, whatever, Smith, she's helping me make $8 billion in 3 weeks. You know, those spam kind of things, they get ripped off, or I delete them just as soon as possible. I'm still having a little bit of carryover with the Rumble comments, these YouTube experts and Rumble experts that they're self-proclaimed in that. They took some kind of a short-term webinar or something, and this is the way they're trying to promote what they do. And I never knew the world was full of so many marketing experts. I do post on YouTube and on Rumble. Sometimes I'll have some problems on one platform and the video will be made available on the other platform first and vice versa. Here's the link. It's also in the description below. Also, I have launched what I call the SPXInvesting Program. It is now live. I'm going to be rolling out more things. I'm going to be locking it down in July. It's $97 a month if you want to become a member of that. If you want to talk to me about this, here's an email address. And there's also a link here that will take you to a program, a playlist on YouTube. I also have the same videos on Rumble that just explains the overall program. Another thing that I recommended a week ago, and I'm still recommending, is there's another YouTube channel, and I have no connection with this channel other than watching the videos. It's Shivako Capital Management. This is a little bit longer term, takes a bigger picture look than what I usually look at, but that can also be helpful to you, especially if these weekly videos are as far as you want to go with the videos that I do. Coupling it with Chris Shivako's videos would probably be a good idea. He does a really good job, and he's a money manager where I'm more of an educator and individual investor. Another thing I want to recommend is a thing called the Kindle Report. This is housed on Substack. It's the same place where I house all of my things. And this is, he has a newsletter that comes out every day, and he's been around a long time. His YouTube videos are available for free. you can watch those. And he pretty much covers whatever he talks about in the newsletter, he talks about in his videos as well. And if you think my videos are long, check out some of his. But he tends to go live, and sometimes people ask questions and he gets a little off track and goes down different rabbit holes and so forth, where I try to keep things a little bit more focused. The reason why I bring him up is he's not a perma bear. He's not a perma bull. He's a realist. And that's what I like to consider myself. But this past week, he made an interesting post where if you look at this chart here, this is his chart with his indicators. And the reason why I'm showing this to you is the report where you see the link along the bottom. And I'll make this available in the description. This is a freebie. This is what he made available to everybody. You don't have to subscribe to his newsletter, which is, I think, $8 a month, to be able to access this chart that I'm showing you. It's a couple of days old now. And then I have a quote down here. He did a YouTube video a few days ago. I think it was on Wednesday. And he took his indicators. And I've also been trying to evaluate his indicators. But when I look at his day in and day out evaluation of the market, I'm kind of coming to the same conclusions already. But he took his indicators and put them on the Fed funds rate. And when he first found this out, he thought interest rates were going to go way down to zero. Now, the last time something like that happened was because of the COVID lockdowns and everything, and the Fed took interest rates and just lowered them to try to keep the economy alive during that time. Since that day on Wednesday when he talked about that, because that could signal something that could be kind of negative. It was a negative thing that brought interest rates down before the COVID lockdowns. It was a negative thing that happened from the great financial crisis. And when he first saw this, he had interest rates going down to zero. He's modified that a little bit as more data has been coming out. Now he sees it being more gradual than he saw it before. But that could mean some kind of a black swan event. Now, it's not going to happen next week necessarily. This is looking out 6, 8, 10 months from now. And we don't know if something like that's actually going to happen or not. I'm not a huge fan of forecasting because it's like forecasting the weather in September on a Wednesday afternoon. I mean, to try to get that right, I think is just folly. But people love that stuff. They also like to do that themselves. And I understand it. I look at the charts and then I just say, okay, what are the charts telling me? And then I basically come to a conclusion that way instead of looking out down the road. But that's just the way I do things. But this seemed, he ran a back test of this on the YouTube video that he has, and it's pretty accurate for what was actually happening. So we don't know if something like this is going to happen. I kind of hope not, because that means something really bad is occurring. And we've got enough to deal with right now, just with things being semi-crazy instead of total crazy at this point. But he says, if the model is correct, and that's a big if, that's what these models do. They project out. There were models that they thought everything was fine back in 2006, 2007. Says, okay, if this happens, this is what we predict will happen. And everything was coming up green at that point, looking just fine. Well, when reality hit, the models ended up being wrong. And it led to the great financial crisis. So no matter how much you put into computer models, you still have to be leery of them. I would just, what I've been saying in the daily videos is, okay, we know this, we're aware that this is happening, and now we'll just watch the charts day by day by day and week by week to see, okay, what's happening. Because these things usually don't just happen overnight. Even the COVID plunge, we were in an uptrend before that, and then we V'd down to the bottom. And what did we do after that? We V'd back up and bounced and went right back into the uptrend we were in before. Now, it was kind of crazy there for a while, and nobody knew what was really going to happen. But we just want to be prepared in case something is happening. And this is one source that you might actually find useful. Okay, let's go back and talk about this week's session. For the week, we were up 1.58%. So we had another up week. We were above average with volume. We are seeing that picking up, and that's been encouraging. We are positive with our technicals, but there are some things to be concerned about, as always. That's why I look at so many different things. We can use confirmation bias, where we just, okay, I want the market to go up, so I'm only going to look at things that support that conclusion that I've already reached. My approach is look at the positive, look at the negative, take it for what it is, be aware of the things that may be going against some of your positions or your portfolio, but ultimately price is the ultimate indicator that we need to follow. Inflation and interest rates. The Fed met this past week and they left rates unchanged, which was not a surprise. Chairperson Powell was not really committed to what they're going to be doing in the future, and that really didn't give the markets all that much direction. We had some friendly reports come out as far as economic reports that are showing that inflation, for right now anyway, seems to be getting more under control. And then we want to keep an eye on the geopolitical events. Last weekend, there was some issues with the French elections, and that's kind of spilling over. And now there's even some talk of them threatening to leave the EU if the election doesn't turn out the right way. And we have an election in the US coming up later this year, and that could be kind of crazy too. So there can be some volatility around those things. And then we're not really dealing with earnings as much right now. We're kind of in between earnings season. And then the Fed speak that we got was pretty much in Wednesday's session. All right, our trend, it's still a weakening trend. We are trending, but it's below its moving average. So it is weakening, but it's positive. And the green line is on top. That means we default to positive. And now the green line is starting to turn back up. And I'll show you that chart here. So for the week, here's some bullet points. The S&P, the NASDAQ, and I don't have it on here. The NASDAQ 100 also hit new all-time highs, while the Dow and Russell were actually down. And so we saw a bit of a mixed week there. It's a small group of stocks that are really driving the NASDAQ 100 and the S&P, because some of those Magnificent Seven stocks, specifically NVIDIA, they're not in the Dow, they're not in the small caps, but they are in the S&P and they are in the NASDAQ 100. So that's really what's been propping up these indexes. But we're not seeing a lot of internal strength inside of these indexes right now, specifically the S&P. Mega caps, the really big companies, they did outperform. Apple was up 7.9% and hit a new all-time high. They introduced iApple or iIntelligence or whatever they're calling it, Apple Intelligence. And that's supposedly going to be coupled with the iPhone. Broadcom, stock we don't really talk about all that much, it was up 23.4% when it came out with its earnings report, and it was quite good. They had a good positive outlook going forward, and they also announced a 10-for-1 stock split, similar to what happened with NVIDIA a few weeks back. Adobe also had a good earnings report, and it was up 12.9%, and they're looking good going forward. The equal weight S&P 500 did underperform. Now, the S&P is a weighted index, and so the bigger companies have more of an impact on how that index performs. The equal weight treats all of the stocks in the S&P the same. That's not holding up quite as much. We're seeing quite a divergence right now between the S&P and the S&P equal weight index. Interest rates were falling this past week, and that really gave support to stocks. We fell all the way down to 4.21% with the 10-year yield. The dollar was up slightly, and that could have put a cap on some of the gains that we were seeing later in the week. The economic reports were taken as positive, and the Fed came in and they left rates unchanged at 5.25 to 5.5. That was expected. Then they came out and made a statement that says the committee does not expect it will be appropriate to reduce the target range until it has greater confidence that inflation is moving sustainably, toward 2%. And this is the scenario that they've been going with. This is what we've been hearing. So there was really nothing new here. And then they came out with this summary of economic projections. At the beginning of the year, the market was anticipating 6 rate cuts. Then it got whittled down to 3. Now it's getting possibly whittled down to 1. And then Jerome Powell really didn't say anything new in his press conference. All right, so for the week, the Dow was down 0.5%, where the NASDAQ was up 3.2%, the S&P was up 1.6%. The small caps, as represented by the Russell 2000 Small Cap Index, were down 1%. So we are seeing a mixed picture there. I've been showing this chart for a year now because we are seeing inflation coming down. We're in the blue area here where we're declining. That's kind of what we saw from 1966 to 1982. What is concerning me, and the reason why I keep showing this chart, is look what happened after that. Now, we don't know if it's going to play out this way, but that's what happened before. And sometimes, even though history doesn't repeat itself, it does rhyme quite often. And we look for patterns to see, okay, the market's acting the same way now that it was 20 years ago. So let's try to match them up and see if we can find any clues as to what may happen going forward. And looking at the RenMac research, we're above the 4.02% with the 10-year yield. We're at 4.21. Even though we're coming down with interest rates right now, we're still above that level where it's biting into corporate profits. Here's some Isabel Nat blog charts. Earnings are still looking good across the board, whether you look at Morgan Stanley or the consensus. It's still going up, and that justifies higher stock prices. This is kind of a funky chart where I had to break out this smaller box area and try to blow it up. I know it's fuzzy. Usually I show this kind of a chart in the daily videos, but it was available for this video this time. Say, today could top off a perfect week. Well, it wasn't a perfect week. We were down a little bit in Friday's session. But this is what does it look like when we do have 5 up days. And here's the chart here where you look 1 month out, 3 months out, 6 months out, 12 months out. And we're not perfect. I mean, but we do see positive results going further out into the future. Then looking here at what are the projections for the S&P based on what FactSet and Goldman Sachs have come out with. Mega cap exceptionalism, we could go all the way to 6,300 with the S&P. Catch up, whatever that means. I guess it goes with mustard here. We could get to 5,900. They think we're going to get up to about 5,600. We're just above the 5,400 level now. This is a catch down. Oh, that's an interesting term. And if we go into a recession, this could put a pressure and the S&P will end up declining. We don't know what's going to happen here, but people love these kinds of forecasts just to give them an idea of what they think might happen. Okay, why isn't this advancing? All right, then we have a number of different sentiment indicators that we look at. Are people too positive? Are they too negative? Well, this is a world look at how people are feeling. The global equity risk love, the old LS, it's over on the left side here. We're getting near that euphoric stage, and this is mainly being led by stocks in the US. We're seeing some problems in Europe right now as they're going through some upheaval. The European markets did not have a very good week. We're seeing the emerging markets not having a very good week. It's mostly coming out of the US currently, and we might be getting to the point where we're getting a little too positive about things and taking the market for granted. And looking at money market funds, this is assets under management. We're at 6.1 trillion. A lot of people took their money out of banks and they're putting them into money markets because they get a higher yield. It's kind of a mistake to think that this is automatic money on the sidelines that's ready to be deployed in the stock market, because some people putting it in a money market, that's as far as they want to go. They don't want to necessarily put it into the stock market, but some of that could end up coming in. So we're seeing an awful lot of money in money markets right now. And growth has outperformed value. When this is going down, that means value is underperforming, and this is world. And then we started to bounce back up, and that's what's been really driving the market higher. We've been underperforming here a little bit with value lately. This was 2022 when value started to really bounce back up. I think I misspoke on that. Now, as this is going down, that's helping stocks to go higher. Then FactSet had one blog post that says, where are analysts most optimistic when they look at S&P 500 companies heading into the third quarter? Well, this is just showing that they're looking pretty optimistic right now with earnings going forward from here. These are the buy ratings on the different companies, and they're going up. This means that if you have a broker with different companies that manage your money for you, they're issuing buy signals, and that's usually positive for those particular stocks. Looking at the intraday chart, we go back to Monday here on the 10th, where we had a nice little up day. We ended up, and this is kind of interesting, we actually gapped lower, but then we're able to end higher on Tuesday. And we saw a little bit of a pattern of that, this, especially in Thursday's session. And then Wednesday was kind of its own day. This is when CPI came out, and the market really liked that. We gapped higher. We kind of hit the top right after the open, and then we just drifted. And then this is when the Fed came out with their announcement. We gyrated around. We closed off the high that day, and that was kind of a scary looking bar on a bar chart to close near the low after gapping higher. But so far in Thursday session, we started higher, came all the way down to right around the 5,400 level, just a little bit above that. And then we saw some late day strength going into the close, and that was more encouraging. We also ended up opening lower in Friday's session. We came down to the previous low that was set on Thursday. We found support there and ended up not really strong. We were down on the day, but we closed at the high for the day. So that's fairly encouraging as well. So for the week, and this is just the 5 trading days, we had the NASDAQ 100, the NASDAQ, and the S&P. They were up. And these are the big indexes that have the Magnificent Seven in them. All of the other indexes during the 5 trading days were down. Going back to the beginning of the year, all of the indexes are up, but now we have small caps, which are slipping back in negative on the year again. Looking at our sectors, the number one sector this past week was tech, and that's rather encouraging. It was up 5.6% for the week. Real estate saw a bit of a bounce back up as we're seeing inflation a bit under control. Discretionary was up, and that's encouraging as well, but it's still really lagging behind. And then other areas actually saw declines with communication. That's another growth area. Healthcare is defensive. Materials can be defensive. Staples are defensive. Industrials, financial, and then energy saw the biggest downward move on the week. Then I look at the next chart, and this is their Scooter score. The higher the number, the better looking that particular sector. We have tech looking the best, followed by communication. And these are the 2 big growth areas. What would help the market even more is down here near the bottom, we have discretionary. It's at 26.7. We would like that to be in first, second, or third place itself. And a lot of this drag is coming from Tesla. So it'd be nice if that would improve and help the overall market. And looking at the sectors just for the week, tech was up. All of the other sectors were down. Now, this is just Monday through Friday. It's not Friday to Friday. So you might see some differences in other statistics that you look at. Going back to the beginning of the year, we have tech, communication, they're positive. All of the other sectors are now negative. Here we are hitting all-time highs with the S&P, NASDAQ, and NASDAQ 100, and we only have 2 sectors that are up on the year. That's a bit of a negative divergence. We want to see more participation from other areas of the market. And looking at our relative rotation graph, plus is up in the upper right. That's the most positive, and this goes back 1 year. Minus, that's in the lower left-hand corner. These are the areas that have been showing the most weakness over the last year. We have utilities, which are starting to roll over a little bit, but they're still fairly strong. Energy, look at how long this tail is here. It's still looking okay, but it's really well off of its highs right now. We're seeing a little bit of weakness in the financials and industrials, and then the materials as well. This is the staples, which had been looking stronger. They're kind of rolling over a little bit now. And then these red lines means that they're declining. We have things like healthcare and discretionary and real estate. These are the weakest areas or weaker areas right now over the last year. Here's just a chart to show you how utilities have been doing good over the last year, but now they're pulling back a bit. They have a really long tail. Energy is still pulling back, but it's been holding up over the last year. Then we have staples and tech. More in the middle is communication, and then we have a lot of different areas that are negative, including real estate, discretionary, healthcare, industrials, financials, and materials. And these are all compared to the SPY, which is the ETF for the S&P 500. Then we look at the markets over the last year, and I'm doing some more research on these kinds of charts, and I may add some more down the road if they're really insightful. But this is just looking at the different indexes. Where we have the OEX, that's the S&P 100. It's looking about the strongest right now. Those are the biggest stocks that make up the S&P 500. The S&P is doing quite well, and the NASDAQ 100 is back to looking better. Where we're seeing some weakness in the mid caps, and that's been a concern for the market because they've been a stronger area for a lot of the year. Small caps are underperforming, and the transportation stocks, they're just not doing good right now. And then we have the Dow Jones Composite, which is kind of zipping around, going up and down here. And then looking at the OEX, the S&P 100, the NASDAQ 100, the S&P. These are the stronger areas right now. Utilities had been stronger, but they're pulling back, as has the composite average for the Dow. Transport, small caps, and mid caps now are showing some weakness. Looking at sentiment. Now, this is interesting. This also suggests that we're seeing negative divergences in the market. We're hitting all-time highs with the S&P, and the fear and greed index is going down. That's because we're not seeing broad participation in this upward move. So we came in at 38, which is actually negative. Looking at this, where we've been going up with the S&P, this has been going down as far as sentiment is concerned. Again, not really suggesting that there's broad participation, something to be aware of. The active asset managers did show a little bit of an improvement, but right now they're not extreme positive. Here's another look. They came in at 86.3, a healthy reading and not necessarily an extreme reading, at least yet. Looking at the VIX, where we're still very low with our readings overall. We're getting down to around this 12, 13 level, both with the line chart and with the bar chart. There's just not a lot of fear in the market. Here's another sentiment indicator, which is suggesting that maybe we're getting a little too exuberant right now. So that's kind of contradicting some other sentiment gauges that we follow. The Ulster Index is also a sentiment gauge. It's going sideways right now, and it's underneath the moving average, showing there's not a lot of fear. We look at the spread between risky and not as risky bonds. This continues to fall, and that's more positive for the market. The bond market is not seeing an awful lot of fear right now. And here's that same thing just represented in a different way. This is high yield spread, and it's just continuing to decline. If this was going up, that means that the bond market is experiencing more fear, and that would be more negative for stocks. Now, here's another look, and I've been showing this lately in these videos, where we have the S&P on top, which is just coming off of an all-time high. We have that same spread that I just talked about, but flipped upside down, and it's matching more what's happening with the S&P. It's off of its highs, but it's still giving us a very high reading. And then the VIX, which is also flipped upside down or inverted here, showing that there's just not a lot of fear in the market right now. You could say, well, the market's complacent on one hand, but on the other hand, you can say, well, things are looking pretty positive, because this is when we tend to see the best returns when the VIX is low, which here it means high, okay, because it's inverted. And when this spread is also low, which right here it looks high, that means we're in a pretty positive environment right now. Then we had the latest reading from Investors Intelligence. It came in at 3.43. We're above 3, but we could get higher than where we're at right now. Then looking at the RIDEX Bear Bull ratio, these poor folks are just getting whipsawed all over the place. This is as of Thursday's close. They were actually going more into the bearish funds, and so they're just getting bounced all over the place right now. Then the latest reading from the American Association of Individual Investors, we are positive. We're just about at this green line, which is just a little bit under 20. We start to get a little nervous when we get above 30. We get really nervous when we're above 40. So we can kind of ride with this right now. And this is you and me. We're individual investors. And I'm actually a member of this group and have been for a long time. Then this is another sentiment gauge looking at things a little different way. We compare cash with the tech sector. This is going down. That means the tech sector continues to outperform, and that's positive for the market. Looking at the economy, GDP now, the latest estimate, coming in just a little bit over 3% with the GDP now forecast. When you look at different analysts out there, we're about 3% to the upside and about 1.5% to the downside. This is showing that same thing, but over a longer period here. We're focusing on the second quarter now of 2024. The takeaway from this is we're still looking positive with GDP. One of the things that is used to define a recession is when we have negative GDP for 2 quarters in a row, and we're looking positive here. And then looking at the Chicago National Financial Conditions, when we're below the black line, that's more positive, and we are below it. Now, this hasn't been updated in a week now. We're looking at the real-time Psalm Rule Recession indicator. We are coming up, but we're still below the red line. We're going to get nervous if we go above that red line, but we're not going to see another reading of this until July, first part. And then this is another monthly updated chart smooth U.S. recession probabilities, showing that we're below the black line and declining. That means that, according to this, they're not really fearing that we're going to go into a recession. Then the Brave Butters, this is updated once a month as well. It's actually coming down. If we continue to go up, that's when we get concerned. And you can see these grayed areas. That's when we ended up going into a recession. As far as inflation, we saw a little bit of an adjustment over the week as CPI was coming out. This was when CPI was released. We're actually coming down a little bit with inflation as far as this forecast is concerned. Keeping an eye on the Fed, the June meeting is now finished. We're now focusing on the July 31st meeting. As of Friday's close, there's an 89.7% chance they're going to leave rates unchanged at that next meeting. And we've been seeing that now for a while. This is the dark blue. That's where we are right now. And we go a day ago, a week ago, and a month ago. So this is getting more locked in for the next meeting. The rates will be unchanged. Now we're starting to look out into September, and this is when the market thinks we might get a rate cut. As of Friday, there's a 61.1% chance that they're going to cut rates 25 basis points at that meeting. There's still 32.3% that think that we're going to keep rates the same. We don't know what's going to happen here, and that's going to adjust as we play things out over the summer. Then here's how things have changed. This has actually gotten a little more locked in now that folks are thinking that we are going to have a rate cut, but there's still a lot of people in the camp thinking that rates will be unchanged. I think it was, I can't remember, was it Morgan Stanley? They think we're going to get a rate cut in July, but it's not really showing up here. Looking at the Fed balance sheet, it is continuing to decline, but we're seeing it going up here with this value. This could be more positive for the market. This means that they're not doing the quantitative tapering as much anymore. They may actually be coming in and buying things, and the market likes that, even though the Fed promised 20 years ago they'd never do this. Now it's become kind of an expected thing. Then looking at the balance sheet year over year, it is still declining as more things are still falling off than are coming on to the balance sheet. Then this is a newer one. These are the overnight reverse repurchase agreements. We just want to keep an eye on this to see if this really starts to go back up like it did back in 2021, and if it's going to continue to go down with that. And if this really starts to move, then I'll spend a little more time going through this. There's a definition right here that I got from Investopedia. Looking at breadth, we are coming down a little bit based on price. We're holding up better based on volume, and we're seeing that similar thing on the daily charts. Price is lagging behind volume right now and has been for the last week or two. When we look at the new highs, new lows, we are languishing a little bit. We're coming down with the new highs. We're also showing a contraction of new highs on the daily charts and a little bit of an expansion of the new lows. So we're kind of mixed up here with our 4-week moving average. We're pretty much flat to slightly declining with our 10-week moving average. And we're coming down, but still positive with the advanced decline ratio. This is more positive. This is a smart money indicator. This is above the moving average, and the moving average is going up. We're seeing pretty much the same thing on the daily chart. So these are confirming each other. So that's one of the more positive things that we're seeing. When we look at our trend, we're finally going back up with the green line, even though we're still below the moving average. This suggests a weakening trend, but we are still positive since the green line is on top and it's going up. Looking at the Erin, we're also positive here, getting a little bit extreme. It measures the green line on top and then the red line on bottom. We saw a little bit of an increase in sellers this past week. That's why we're seeing this oscillator coming down slightly, but it's still positive. The mass index is not generating a signal. Here's a daily chart where we got above this pivot point right now. We're going to be watching this area to see if it ends up providing support if we see more of a pullback. If we continue to go up, we'll be watching some of these other pivot areas to see if they provide overhead resistance. We've been above average on volume on the daily chart here, but we did drop below average in Friday's session. Looking at the Keller market model, we're positive across the board with the S&P. We're negative in the short term. When we look at the mid caps and small caps, we're positive with the NASDAQ 100 across the board. And looking at some different markets, stocks are positive from short term, intermediate, and long term. Bonds are still negative in the long term. Commodities are negative in the short term. The dollar is seeing a bit of a rebound here, and it's actually positive on all time frames. The decision point scorecard, they did come in and make a change here. We're positive across the board with this model that we look at. We are positive when we look at this trend channel going back to 2009. Things are just holding up well there. This is interesting. And I was just harping on this chart a few months ago. Now I'm back to looking at it again because we got above this R1 level. Now we're starting to come up to this R2 level, which is at about the 54.31 level. You could round it up to 54.32. Is that going to provide overhead resistance? To show you what I mean by that, we were just roaring to the upside back in 2021. We hit one of these pivot points and then we went into 2022. Then we started to bounce up out of that. In 2023, we hit another one of these pivot points. Then we saw a 10% correction. We finally got above this R1 level, broke down below it as we saw some weakness. Now we're coming up to R2. Is this going to present an issue for the market? It might. But when we look at the trend with the 50-period simple moving average, which is 50 weeks, we are looking solid. The red line is going up and price is above the red line. Our moving average crossover still shows that we are in a solid uptrend. This is where we're starting to see some negative divergences. We have the S&P setting recent all-time highs. We have the McClellan oscillator actually below zero and declining. That's not a good sign. So when we look at the summation index based on price, we're still positive, but we're coming down. We're also coming down, but still positive based on volume. Not really what you want to see when the market is really strong. The Swenlin trading oscillator, it's already dropped below zero based on price, and it's dropping below zero based on volume. That's another negative divergence that we're seeing here on the weekly charts. The bullish percent index, it hasn't really been moving all that much. We're setting all-time highs with the S&P, but we're just kind of going sideways here with the BPI. We want to see this going back up, and this measures the point and figure buy or sell signals inside the S&P. And with this going sideways and the S&P going up, that just means only a few stocks are really pushing the market higher. When we look at a momentum, we're starting to turn back positive with the PMO, but we're still below zero and declining based on price. We're declining, but still above zero based on volume. And we're seeing a little bit of a weakness here with the PMOs that are rising. Again, as the S&P is going up, we want to see this green line going up, not going down. The PMO signals, the buy signals, they're kind of declining just a little bit, something that we wouldn't see in a solid market. Also, the PMOs that are above zero is continuing to decline. Now, we have to follow price, and this could end up taking care of itself. But we want to be aware of this, and we're seeing a lot of these similar things on the daily charts just to be prepared in case things really start to turn negative. Then we did, and this is not something that happens very often, we actually closed outside of the upper Bollinger Band on the weekly chart. We were up above it for 2 days on the daily chart, but to see this go above on the weekly chart, that means that we're overextended to the upside. You can look back through time, and we don't spend very much time above this either upper or lower Bollinger Band. So the idea that the band's going to have to go up or price is going to have to come down or a combination of the two. Looking at our oscillators, we're still declining, but trying to turn up with the slope, and we're actually turning back up with the TSI. So these are shorter term. We're looking better with the MACD, trying to go back positive with the PMO and the PPO. We're still declining, but trying to show some improvement with our longer term oscillators, the TRIX and KST. The chicken money flow, this is another smart money indicator. We're looking quite positive on the daily chart. We're hanging in there pretty well here on the weekly chart. The Chaikin oscillator, another smart money indicator, is going up, and we're getting above this green line. We're also above this line on the daily chart as well. It might suggest we're getting overextended to the upside, but for right now, we can also see it as good momentum. The force index is above zero and going up. That's positive. We're going up with the money flow indicator. That's positive. The rate of change is up because we had an up week. The rate of change going back 50 periods, we're still above this red line. We're pretty much sideways here. But sometimes when we got to this red line, that marked some kind of a top in the market. But we could still go higher than where we're at right now. The RSI based on 14 weeks is now getting extreme positive again. We want to be aware of that one. The special K chart continues to be negative. It's still it's getting close, but it just cannot seem to cross above that red line. The Stochh RSI is above the midpoint and advancing. That's positive. The Williams percent R is looking extreme positive. Again, you could say, oh boy, we need a pullback from here. Or, wow, look at this. This is showing good momentum. Ultimate Oscillator looking extreme positive. The Vortex is finally turning back up and the green line's on top. So that is turning more positive again. The Copic curve is trying to cross over its moving average, another momentum oscillator, but it hasn't quite done that yet. We didn't come down and hit any of these support levels here on this weekly chart. We're well above them at the present time. We are starting to turn back up with our 253 period simple moving average of the equity put call ratio. The reason why I picked 253 days is that's pretty much the number of trading days. Instead of a 200 or 260, I actually went with the literal number of days for this particular moving average. When this is going down, that's more positive. When it's going up, that can be more negative. We look at the VIX and then a 3-month average of the VIX and take a ratio. This is positive because it's continuing to decline. Then looking at our different charts based on the trend, we are looking positive here with the Heiken Ashi. We're looking positive with the Kigi chart, positive with the Renko chart, positive with the 3-line break. And we're seeing that same thing on the daily charts as well. We have solid uptrends. It's internally that's causing some concerns to us right now. Then the ease of movement is above 0 and going up based on 14 weeks. We did get a new X drawn in here with the point and figure chart. We went up just enough to have that generated. We're still working off of a double top breakout that was generated back on May 13th. And looking at another momentum study here, longer term, we're starting to go back up, but we're pretty much flat here. We're also pretty flat in the intermediate term. We're looking a little more positive in the short term. We did hit a new cycle on June 4th, and so far it seems like that seems to be to the upside, but this could always change. And then looking at the Elder's Impulse system for the S&P, we have green bars for the last 2 weeks. That is positive. Okay, what's going on? Then we look at the parabolic SAR. We are positive on the daily chart, and we're also positive here on the weekly chart. Then looking at seasonality, right now it looks like we're up in June 80% of the time with a return of 1%. And then looking at just the indexes, we have the S&P hitting all-time highs. The mid caps, they haven't surpassed this previous high yet. They're showing a little bit of weakness. The small caps are just chopping sideways pretty much for all of 2024. The Dow is in an uptrend, but it's one of the weaker indexes. It's been able to fall below its 13-week moving average here, but it's still in an uptrend. The NASDAQ hitting all-time highs and looking really solid. NASDAQ 100 also all-time highs. Here's another look at the QQQs as represented by the NASDAQ 100, also hitting all-time highs here. The mid caps, they're coming down and dropping below the 13-week moving average, but this has been a stronger area. We'd like to see this kick back into gear. The small caps chopping sideways and dropping below their 13-week moving average. The NYSE showing a little bit of weakness here. We're setting all-time highs with the S&P and NASDAQ 100. We're seeing a little bit of weakness. This is a broader market indicator. And this is a daily chart of another broad market indicator, the Wilshire 5000, coming off of recent all-time highs. All stocks still looking really solid here. The big software companies not looking all that great, but not necessarily looking terrible enough to see a death cross yet. The FANG index setting all-time highs here. Those are the big mega cap stocks. ARC kind of languishing right now. It was up 0.16% for the week. We're starting to see a death cross on the daily chart. It's just about ready to give us a death cross here on the weekly chart, which is really disappointing. This was a real favorite and a real big ETF that a lot of people got into it just about the wrong time, and that's kind of sad. Here's the weekly chart of the KBW Bank Index. Did see some pullback in the banks, and we're seeing a little bit of a downward turn, starting to drop below the midpoint with the RSI. We're rolling over and looking more negative with the momentum. Then we are seeing money going back into banks for right now, and people aren't running and getting their money out of banks, at least right now anyway. Here's just a weekly chart of Dow theory, where we're seeing some weakness here in the Dow. It hasn't come back and set a new all-time high. The transports have just been trailing off. They've been a real disappointment. The utilities were going up really strong, but now we're starting to see them coming back down. Some broad market measures that we look at. The CRB index, which is commodities or are commodities. We are in an uptrend here. Oil It's still below 80, but it did have a pretty good week this past week, got up into the high 70s. Copper, after really shooting up, has been coming down, but it was up slightly on the week, and it is in a longer-term uptrend. The dollar is also in an uptrend. It bounced back up into the 105 range this past week. Gold is still chopping sideways here. We got back above this 13-week moving average. And silver also seeing a little bit of weakness, hasn't come down to its 13-week moving average at least yet. Keeping an eye on the price of bonds where interest rates have been going down. So we're seeing this total bond ETF going up. And we look at a monthly chart of stocks to bonds, it actually ticked down a little bit as bonds were outperforming stocks, unless you count just those stocks that really seem to matter right now, the big stocks. This is a different way of showing a chart that I had been showing for a while. The blue, that's the 1 month yield, and then this is the 3 month yield. And this is the way it should be. For a while, we were seeing the red line above the blue line, and it's like, okay, how come 3 month yields are higher, or they should be higher? We'll just keep an eye on this to see how this is going. But this is kind of strange that we see the 1 month yield actually higher than the 3 month yield. I got that backwards when I first started. But we're seeing a real decline right now when we look at the daily chart of the different yields. There's a weekly chart where we came down with US and UK rates, German rates fell, and Japanese rates fell. This could give support to stocks. Looking at our intermarket analysis, where we now have stocks in the lead year to date, followed by oil and then gold, and then we have the dollar. Bonds are showing an improvement here, but they're still negative on the year. We look at a ratio between the NASDAQ 100 and the S&P 500. They're both doing really well, but the NASDAQ 100 is doing even better, which you would think in a more solid environment, that's what would happen. We were getting kind of close here, but now we're starting to go back up. When we look at the S&P 100 and compare it with the S&P 500, the big stocks are outperforming. Growth to value showing some improvement this past week, and that's encouraging if you want to buy low and sell high. That's when you buy growth stocks. Looking at gold to the S&P, not really seeing much of a change here. We saw a golden cross with this ratio, but since then, we've been actually dropping back down as gold has been underperforming the S&P. And here's gold to the dollar. Saw a little bit of an uptick. It broke out, but now it's just been kind of chopping sideways with this ratio. We look at bonds and show how they are underperforming stocks on the weekly chart. This is low volatility, really underperforming. And that's what we see in a more positive environment. And discretionary, this is an area that's disappointing. We actually saw a death cross here. We want to see this ratio going up, meaning discretionary is outperforming staples. Staples is a more defensive area, and it's been outperforming lately, both on the daily charts and here on the weekly charts. We look at a ratio between energy and tech, where we're seeing energy now starting to underperform, and it's in a longer-term downtrend when compared to tech. Then we look at our longer-term cycles here. We hit the low in October 2022, and we've been bouncing up off of that. That's the low that we set, and we've been working off of that ever since. We have not seen a new ZWAG NYSE breadth thrust. We got really close. We missed it by 1 day. Excuse me. But this has just been kind of languishing around lately as we're not seeing a lot of broad participation on the market. There's a Horchak, another long-term signal that we follow. It's still on a full-on buy signal. And then we look at a long-term chart going back to the 1987 crash. We're well above this with the weekly chart of the S&P. This is a further blow up of that same chart. We're well above this trend line currently and looking pretty solid. We look at the NYSE new highs minus the new lows. We're coming down, but we're still above zero. We'd like to see this turn and actually go up to support the market going higher. This is just based on the S&P, a 50-period exponential moving average of the new highs, new lows, also coming down as there are fewer stocks that are supporting the S&P 500, but we're still above zero with this chart. Here's a weekly chart of the NASDAQ 100. We're breaking out even further above this trend line going back to 2009. This, I'm not sure what the perma bears are going to do about. They thought that this was the holy grail of the end of life in the stock market as we know it. We came up, we set a high back in 2000. This was the dot-com boom. We came right up to this same level in the end of 2021. Then we went into 2022. We're coming back up, and these guys were just salivating, thinking, oh, we're there, everything's going to fall apart. Well, now we're going even higher and setting a new high with this ratio currently, and I'm not sure what they're going to do about that. We're seeing that same thing here with the Qs, which is the NASDAQ 100 to the small caps, also breaking out with this ratio. Semiconductors to the Dow, also breaking out. They didn't think this was going to happen. They thought we were going to come back, hit this, and turn and just go in the toilet. And that still might happen. We don't know if something like that's going to play out. We just go with what we're seeing right now. We're not seeing a big improvement here with our cumulative new highs, new lows for the NASDAQ. It was declining for years. Then it finally started to turn back up, and now we're pretty much leveling out these days. And we want to keep an eye on the 3-month yield. We're going sideways with this right now. If we really start to fall, that's what happened when we went into the great financial crisis. It's not happening yet. Then we have this thing called the Hindenburg almond, which the perma bears are all salivating about. I have a description of it here. Please feel free to stop and look at this if you want more of a description. There are really 3 things that go into this signal. Here's what it looks like. We have, and I should have put it on here, it will be June 18th, because this was triggered. We have 20 trading days after this has been triggered to see another spike right here. And we have until Tuesday, June 18th, to see that second spike, or this initial spike is going to fall off the books. Now, I calculated those dates myself. We could be off by a day or two, so be aware of that. Now, an interesting thing is we're looking at all kinds of confirmations here with the NASDAQ. This is generating Hindenburg omens. One of the perma bears that I follow is even talking about the Dow, but I don't calculate that one. But is this always a bad thing? Well, look at for 2024, look at all the signals that have been generated and look at what the NASDAQ's been doing. This is not the NASDAQ 100. This is the NASDAQ, the really broad index for the NASDAQ. But we're seeing a lot of spikes here. Are we going to fall apart? Maybe, but we haven't fallen apart yet. So we want to just keep an eye on this. And seasonality, where this is Dan Bird's chart, where we still have some positive seasonality until we come up into the end of June. This is also looking positive if we compare 1982 with 2023 and now going into 2024, still looking pretty solid there. When we look at the election years going back to 1950, we're up 15 out of 18 times. We're down 3 out of 18 times with a return of 1.3% for the month. June is okay when we look at this, just going back monthly to 1950. It's not all that great when you take all of this together, but it's still positive. And it's actually down when you compare it on a world basis. Then we look at May through October. This tends to be more the negative time. Now we're coming up into the June to November period where it's looking a little bit better for these 6-month period of time. In June, during an election year, going from 1950 to 2023, June and August tend to perform quite well. July is also up, but it doesn't perform quite as well. Then looking at the Stock Traders Almanac and what they're coming up with here, this is a little bit outdated now with this purple line here. Is that pink? I don't know. But when we have the top quarter during an election year, we tend to see, that's the red line, we tend to see positive results. When the sitting president is running for re-election, which is what is happening, we also see positive results. Okay, and then we take the blue line, that's everything together. And then we have, if we have a down April and then an up May, that's the brown line that we're starting to follow a little bit now. And that's also positive before it tends to turn more negative going into the end of September, or actually September and into October. So I got a lot of different things to choose from here. And then looking at the seasonal pattern, this is more of that dip in April, May gains. We're going June forward. It's not straight up, but we tend to see an overall uptrend when that happens. This is similar. This is looking at the NASDAQ, where we see a little more bumps in June and July before we start to really take off in August and September. And then the seasonal pattern, well, this is more updated here. We're actually tracking back to 2012. That's the blue line, where maybe, to see this was, I didn't get to update this chart since the beginning of May. We did come down a little bit. Maybe we're going to start to go back up when looking at this chart. We do see some positive seasonality if we stick with what happened in 2012. We also look pretty good for June, July, and August here when it's the 4th year of a presidential cycle. And also when we take June and look at it different ways, going back to 1950, we're positive. The past 20 years, we've been negative. The past 10 years, we've been positive, and during an election year is when we are most positive. And then looking at the June, July, and August, where we tend to see good returns in June, positive results, but not as good in July, positive and not even as good in August. Here's another seasonal chart. We're right in here where this red box is. We actually tend to perform better during a non-election year, where we might see some choppiness here during a presidential year. This is a median measurement going from 1976 up to 2023. And then looking at the first half of June, we're just starting to finish that out. That tends to be more positive, where here the second half of June can often be negative. Thank you. I really hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.